Hi guys, hi, good morning. So we are going to be looking at adjustments to the final accounts. So far we have prepared the accounts as though everything is pretty okay and everything is fine. We have entered all the entries. Um, we have dealt with certain errors, looking at the suspense accounts. But now we're going to look at a couple of things referred to as adjustments. And the first thing we're going to look at is this thing called accruals and prepayments. We're going to look at accruals first. So we're going to be talking about the matching concept. Yes, and we're going to talk about the accruals concept, if you like, and we'll also discuss what we mean by prepayments. Yes, why do accruals occur? And sort of adjust the income statement and the statement of financial position to take into account these adjustments. Right. So we've discussed this before. A lot of transactions are done on credit. Yes, and the key issue here is that we always want to match expenses with income for the same period. This is the only way we can judge whether a business is good or not. Yes, so we don't wait until we pay via cash or until we receive the money. We record it as soon, if you like, as the product has exchanged hands and we have an invoice of some sort, which gives us legal right to receive that money. So, or vice versa, whether we, have a legal duty to pay a certain amount. So we record the transaction occurring as at that point. So let's very quickly look at two businesses just to sort of illustrate what I'm trying to explain here. Yes. So here we have two businesses, company A and company B. And as you can see here, you have company A has income of 10,000, both very similar companies. But what I want you to do here is I want you to go down to rent under expenses, and you can see here that under rent, company A has recorded its 3,000 and company B hasn't. Now, for whatever reason, company B could have said, oh, we're not recording rent simply because maybe we haven't received the invoice yet. But here's the thing, company B has been in the premises, has used and occupied the premises to generate that income of 10,000. So the accruals concept says, well, if you've used an expense to generate income that you are recording, then you are obliged to record the relevant accompanying expense for that period only. Nothing more, nothing less. Right? So that's really important. That's what the matching concept is saying. So let's match the exact income. Let's match the exact expense for the, well, same thing, income for expense for that period. And you can see here, if company B is not to record its rent for whatever reason, it would appear to have a higher profit, a higher net profit at the end of the period than would company A. And you might make the wrong judgment. So you can see the whole point. These adjustments are really key and are important for the benefit of the shareholder, or for the user of the accounts, if you like, the stakeholder. Yes, now we've just discussed this here, and this is what we're saying. Company A, exactly same conditions, not recorded the rental cost for whatever reason, because the invoice has not been received, but it's really important that it does. Yes, and this is the 3,000 I've talked about, for whatever reason. And our aim, again, is to ensure that all expenses relating to that period are included in that period. We're not interested in anything outside the period. Right, so let's sort of, play with that and sort of see what we're, how that works. So, here we are. So let's create some, some T accounts and just sort of see how we sort of deal with this. So what we have here is, in this case, we have a situation where we have rent, right? Now, he hasn't received an invoice. So, ordinarily when he gets an invoice, you can put it in an expense day book, or just, something to actually record it. That's your source document, but you don't have a source document in this case. So we get to the end of the year and we're like, what are we going to do? We have used up rent, but we don't have any source documents. What we do is we still create the rent account because you have used it. It is an expense. But we create another account, if you like, called the Accruals account. Yes? I mean, it's a creditor account, isn't it? You owe it. It's like buying purchases, or buying goods, sorry, on credit. You would have debited purchases in exactly the same way, and credited trade payables. Yes, it's exactly the same idea, but this time we're talking about rent. So let's just set the figure we had in the other case was this case of 3,000. So if you like, we debit 3,000 to rent, and we credit the accruals of 3,000. This is a trade pay. Technically, this is a payable. It's not not trade payable as we know it, but it is a payable. It's something you owe, right? It's a liability, isn't it? L. Yes. So this is how we deal with expenses that we have used, but we are yet, if you like, to pay for. And you can see this will, when we tie this up, this will transfer to the income statement as usual, 3,000, and close off. And this will transfer, this accruals account will go to the balance sheet, or to the statement of financial position. This is transferred to balance sheet as well. Will balance carried down, and the balance, this is the carry down. This pen is a bit, I'm going to have to adjust this pen in my next pen voice cast, and that's 3,000 brought down. And this you will see under your your current liabilities in your statement of financial position. Yes. Let's look at some of the examples that I've given you in your exercise. So this is our first example. This is the situation. So accounts are prepared for the year. Some things aren't matching. We've used a resource. We've talked about it. You need to record the expense. You also need to record the fact that you have an obligation to pay. Yes, that's the in part B over there. So for example, if the bill for the electricity is 1,200 and you get to December and you realize you've only paid 1,000, what should you do? And it's for 1,200. You know it's for 1,200, but you haven't quite. Let's go to a new one. Let's not see that. Okay, so here we are. So this is what must have happened. Yes, you paid. Here we are. Let's have electricity, and let's have bank. So you had paid, as you would, £1,000 out of your bank, £1,000, and you get to the end of the year, and the invoice arrives, and the invoice says you actually owe 1,200 because you have used 1,200 for the year, but so far you've only paid 1,000. Well, if you've used 1,200 for the year to generate whatever income you have generated in that year, you are obliged to include or make sure you have a total of 1,200. And the only way to make sure you have a total of 1,200, if you like, I guess I use a different color here, is to include the additional 200. And then we create an accrual of 200. You can see that you can't put 200 here because you haven't paid for it. So the 200 must come here in the accrual. So now we can transfer to the income statement 1,200, and this closes off. That's the end of this account. The electricity account is done. This, of course, is a balance carried down. 200. Pull down. 200. And of course, the bank just does what it does. That gets brought down as well. That's in the balance sheet as well. Yes. So that's how we would have dealt with that exercise. So we can now, when we go to our income statement, we will see 1,200 there. 1,000, fair enough, has been paid, but 200 is still owed. And all we have to do is reference the balance sheet or the statement of financial position and look under trade, look under current liabilities, and you will see you should have this accrual there because it's not going to last for up to a year. You're going to pay this off as soon as you get into the next year. And let's look at I think there's another one there that we have given you. And here we are. It says you need to record 200 for the, well, sorry, this is the answer. You need to record 200 for that month. And yeah, so this is prepayments, and we'll look at this in the next screencast on prepayments. But what we have done so far is we have dealt with the accruals concept, if you like. And the accruals concept, again, going back to the key point there, are